Hello everybody, I am Tapus Chakraborty FCMA and on behalf of DM Tutorial, which is dedicated to challenging hardship of students, especially those who are pursuing studies on higher courses on subjects like economics, financial accounting, cost and management accounting and quantitative techniques. Now, today's chapter is classification of cost, which comes in cost and management accounting subject. Before we go to the specific topic, I have some words about cost and management accounting. That means what cost and management accounting basically mean. All of us have heard about financial accounting and financial statements, profit or loss, expenses, revenues, etc. of any listed company can be available by simply accessing internet. So one can easily say what was the profit of Coke last year, what was the profit of Pepsi last year, or for that matter, what were their expenses if they incurred losses, so what was the amount of loss of the companies, etc. So these informations are available from the annual audited financial statements of listed companies. Many other things are available in the financial statements, which consist of income statement that shows the result of operation of business in the preceding financial year. Second, the balance sheet, which shows the financial position of the company on a particular date, generally on the last date of the previous financial year. And thirdly, a cash flow statement that shows where from cash has come in and how the company has used the cash. And fourth and finally, there is statement of changes in equity. That means how the equity share capital base of the company has changed during the year. So many information are available from these audited annual reports of the companies. But certain information are not available in these reports. For example, if the company has made any capital expenditure, that amount is available. That means how much the company spent on capital investment is easily available from the income statement, from the cash flow statement. But why the company made this decision, that is why the company decided to invest present money for future benefits, is not available in the audited annual reports of the company. In the same way, suppose a company had been producing a particular spare part of its final product in its production unit using its own facilities, and in a particular financial year the company decided to outsource the production and cease producing the product in their own production unit. That is also, this information is available in the financial statements, in the cash flow statement or in the income statement if there is a lease rent. But why the company took the decision to cease production and outsource to a third company is not available in the financial statements, that is the audited annual reports of the companies. Why this information are not available? Because these information are meant for internal purposes of the company and are dealt with by the management staff of the company. So there is a fundamental difference between cost accounting, or you can say cost and management accounting, and financial accounting. Financial accounting is basically for external stakeholders, that is for the shareholders, for the government, for the long-term creditors, for the short-term creditors, so and so on and so forth. Even the tax authorities, the environmental department of the government, etc., and the community at large. But the information, as I just talked, like why the company took the decision, what analysis guided the company to take the decision, are not available in the financial statements and are not accessible by any external stakeholders, not even the rival company or the competitors. Number two, financial accounting is basically a post-mortem accounting. Why it is post-mortem accounting? Because after a transaction, a monetary transaction takes place, that is recorded in the system of financial accounting. So financial accounting cannot change the transaction. A past event is being recorded in the journal, ledger, and ultimately the final accounts are prepared. Sorry. But cost accounting, or you can say cost and management accounting, although there is some differences between cost and management accounting, which I will come on at a later stage. Cost and management accounting is not at all post-mortem accounting. Rather, cost and management accounting is a future-oriented system of accounting meant for internal purposes of the company. That is, to strengthen the position of the company, to strengthen the competitiveness of the company, to strengthen the sustainability of the company, and to strengthen the profitability of the company and growth of the company, etc., etc. Now, as I just said a few minutes back, although we use cost and management accounting as one term, but basically there are some differences between cost accounting and management accounting. Cost accounting analyzes, collates, records the costs to determine what is the cost of production, what is the cost of sales, and what is the profit of the company. Now, in the process of doing so, ultimately a system of cost accounting enables the company, enables the management, I must say, to control cost, to reduce cost, to determine cost, and to price the products. These are the functions of cost accounting. Many records are prepared in the system of cost accounting. Now, what is management accounting? Management accounting is basically meant for making management decision assisted by cost accounting records. There are many tools, methods, techniques, concepts, ideas, theories, etc. are used in the management accounting, and the data to use those are provided by cost accounting. And the management accounting records are maintained by the MIS, that is Management Information System of the company, which is fully computerized and meant to assist management in making decisions. Now, classification of cost. Costs are fundamentally divided between two elements or two categories. Those are, one is prime cost and another is overhead. And a summation of prime cost and overhead cost gives us the total cost of the company for a particular financial year. Now, there are divisions of prime cost as well as overhead costs. Now, I would request you to see on my copy where I have written down the classification of prime cost and overhead costs. I hope you are able to see what I am going to write. direct material cost, direct wages, and direct expenses. These three make prime cost. On the other hand, as a counterpart of direct material cost, there is indirect material cost. As a counterpart of direct wages, there is indirect wages, and as counterpart of direct expenses, there is indirect expenses. These three make overheads. Now, direct material cost plus indirect material cost gives us total material cost. Similarly, direct wages and indirect wages give us total wages. And finally, sum of direct expenses and indirect expenses is called total expenses. If we add these three, we get total cost. That is, prime cost plus overheads equals to total cost. Now, I am going to define what the elements of prime cost means. Number one, direct material cost. Direct material cost is the cost of those materials which are embedded in the output, that is, which are physically present in the output. Say for example, in furniture business, wood and nails are direct material cost. Next one is direct wages. Direct wages are the wages of those employees who are paid on piece rate system of payment. That is, they are paid according to the number of units they have produced. And third one is direct expense. Direct expense is neither direct material cost nor direct labor cost or direct wages, but it is directly related with output. Now, examples of direct expenses are not very common and are mostly seen in electrical and civil engineering, construction and installation companies. Say for example, for a construction company, the cost of drawing or designing a project is direct expense, because you cannot tell it is direct material cost, nor you can tell it as direct wages, but it is directly required for producing the product, because in construction business, the whole project is considered as one unit. Okay, so these are elements of prime cost. Next, we come to overhead. Now, what is indirect material cost? Indirect material cost is the cost of those materials which are not directly related to output but needed for production. Say for example, the sandpapers needed to smooth the woods in furniture business are indirect material cost, because sandpapers are not physically present in the final product. Indirect wages. So what is indirect wages? Indirect wages means the wages of the employees who are paid according to time rate system of payment, that is either weekly, fortnightly or monthly. And what is meant by indirect expense? Any expenses other than indirect cost, indirect material cost, indirect wages under overhead are called indirect expenses. There are many examples of indirect expenses like rent, electricity, depreciation, maintenance cost, insurance premium, etc., etc., etc. So prime cost means the direct costs or variable costs which are directly related with output, and so prime costs are all functions of output. So prime cost or variable cost is a function of quantity. Q is the quantity of output, and fixed cost or overhead cost does not vary with output, but it varies with time. Say for example, rent of the premises, office premises, or rent of the factory does not change if output level changes, because this expense is contractual, that is predetermined. If a manufacturer does not produce anything in a particular year, a particular month, still he has to pay the full rent for the month or the year, as the case may be. So fixed costs are functions of time. Fixed cost equals to the function of time. T equals to time. Now we will see how overhead expenses are classified. Overhead can be classified according to their variability, that is the relationship with output. Secondly, according to the functionality, that is what function the overhead expense actually provides. And thirdly, element wise. Now I will once again request you to see on the copy where I am writing the classification of overhead expenses. Now overhead expenses or overheads, as loosely called, can be classified as variability, functionality, and elements. Now by variability we mean in what way the expenses incurred is related to output. That means whether the expense is fully fixed or the expenses vary with output. So there can be three classifications under variability, that is fixed overhead, variable overhead, and semi-fixed overhead. Now fixed overhead is fully fixed and does not vary with output, and totally it is a function of time. And variable part of overhead also does not directly vary with output, but changes at output changes. As we all know, one part of the telephone bill and one part of the electricity bill is fixed for the month, and another part depends upon the usage of the equipment or usage of the asset. So that is variable cost, and that part which is fixed for a month is a fixed part. That is fixed cost. Third one is semi-fixed cost or semi-variable cost. These costs are partly variable and partly fixed, and these costs are further bifurcated into fixed part and variable part and added with the fixed overheads and variable overheads respectively. Next comes functionality. Functionality means for what purpose the expenses are being incurred. There are three chief functions of any company. One is manufacturing, Second one is administrative, and the third one is selling and distribution, S and D. So there are three functions: manufacturing function, administration or administrative function, and selling and distribution function. So the overheads, those are incurred for manufacturing, that is the overheads those are incurred within the factory are called manufacturing overhead. Examples of manufacturing overheads are factory rent, factory electricity, factory power and fuel, wages of the workers, wages of the factory manager, etc., etc. All these expenses are incurred in the factory itself. The second category is administrative expenses. The administrative expenses are incurred to run the business properly, that is to employ administrative staff or office staff. All those expenses incurred for maintaining and running the office are called administrative expenses or office expenses or general expenses. Examples are like salary of staff, salary of office manager, salary of the directors, rent of the office building, insurance of the office building, etc., etc. And third one is selling and distribution overhead. Now, what is selling and distribution overhead? The overhead those are incurred for selling and ultimately distributing the products to the end consumer are called selling and distribution overhead. Say for example, a company is manufacturing certain products and it is distributing the products to the dealers who are geographically scattered by using the company's vehicles. So the cost of maintaining the vehicles, cost of running the vehicles, cost of the salary of the driver who is driving the vehicles are all selling and distribution expenses. On the other hand, the cost of publicity, advertising, promotion, etc. are all part of selling and distribution expenses. Even the commission of salesmen are also part of selling and distribution overhead. So costs can be divided primarily between prime cost and overhead cost. Prime costs or variable cost or direct costs are function of output because they vary with production, and the overhead cost, that is the costs over and above prime cost, which are not directly involved in output, producing the outputs, but which are necessary to keep the unit operational. And overhead expenses can be classified according to the functionality, that is the manufacturing overhead, administrative overhead, and selling and distribution overhead. And third category is element wise. As I just explained in drawing the cost matrix, that is the prime cost and division of prime cost and overhead cost, etc., you must have noticed that indirect materials, indirect wages, and indirect expenses under the overhead category. So element wise, these three, that is indirect material cost, indirect wages or indirect labor cost, and indirect expense, these three make overhead. So according to element wise, these are the division of overhead cost. So according to variability, overhead cost can be fixed overhead, variable overhead, and semi-fixed or semi-variable overhead. According to functionality, overheads can be manufacturing overhead, administrative overhead, and selling and distribution overhead. And according to elements, overhead costs are indirect material costs, indirect wages or indirect labor costs, and indirect expenses. Now I would once again request you to look at my drawing of variable cost curve and fixed cost curve and the total cost curve, that is fixed cost plus variable cost make total cost, and how the curves are derived. On the x-axis we measure output, and on y-axis we measure cost. Since variable cost or direct cost directly varies with output, if there is no output, then there is no variable cost or direct cost or prime cost. So at zero output, the variable cost will be zero. So the variable cost line starts from the origin, and since variable cost or prime cost or direct cost directly varies with output, the variable cost curve or the direct cost curve will be an upward straight line like this. Say this is Q1, this is Q2, this is Q3. This is V1, this is V2, this is V3. So for OQ1 units, the firm is paying OV1 variable cost. For OQ1 units, the firm is incurring OV2 variable cost. For OQ3 units, the firm is incurring OV3 variable cost. And as a result, the variable cost is an upward straight line. But what about fixed cost? Fixed cost does not vary with output but varies with time. Whatever be the number of units produced, the producer has to pay the prefixed or contractual fixed expenses. Now in this diagram we measure output on x-axis and cost on y-axis. Now since fixed costs are fixed irrespective of output, that is even at zero output, the entrepreneur has to pay certain amount of fixed cost. So the fixed cost line starts from the positive intercept of y-axis, say from here. And since for any output within a given time period the fixed cost remains fixed, it will be a straight line parallel to x-axis. So this is fixed cost line. Say this is OF. So OF is the amount of fixed cost whatever be the output. This is Q1, Q2 and Q3. So for OQ1 units, this much is variable cost and this much is fixed cost. For OQ2 units, this much is variable cost but this much is fixed cost. Again for OQ3 units, this much is variable cost and this much is fixed cost. So fixed cost remains fixed. Now if we add fixed cost and variable cost, we will get total cost curve. In this diagram I am drawing the total cost curve. On x-axis we measure output and on y-axis we measure cost. Sorry. So this is fixed cost, this is variable cost. If we add this fixed cost with variable cost, we get total cost, that is parallel to the variable cost line. So this difference is equal to this difference. Okay, so variable cost is an upward sloping curve starting from the origin. Fixed cost is a straight line parallel to the x-axis, and the total cost is a summation of fixed cost and variable cost, and that is also parallel to the variable cost line. And the total cost line starts from positive intercept of y-axis, since there is a positive fixed cost irrespective of the output. So in nutshell, this is all about classification of costs between prime cost, overhead cost, and again overhead cost into different categories according to um, functionality, variability, and element wise. I believe you have enjoyed this lecture, and I expect this will go a long way in providing you some useful insights in understanding these subjects in depth and with full strength. So let's call it a day. Watch my next video on absorption costing. That is very important topic in cost accounting, and we can say cost and management accounting. Okay, thank you very much for watching this video.